Hello guys, I hope everybody is doing good. We're going to be starting out with this chapter called as country risk. Okay. Now this chapter will ideally give you around one question in the actual exam. It's a theoretical chapter. Okay. Where the focus is to help you understand. Okay. Help you understand why, first of all, why credit risk is important for you as a risk analyst. Okay. Second, what are the factors that will decide the credit risk or will impact the credit risk? Then how do we measure it? Measure in the sense, how do we understand that, okay, India has, say, lesser credit risk as compared to, say, Bangladesh or as compared to, say, Sri Lanka? Okay, what is a measure? How do we analyze a credit risk for a country? And what is the implication for the investor? Okay, so this implication part is slightly important. I'll be highlighting the sections. Please mark it as star as I do it. Okay, so let us start with the discussion, which is country risk chapter. Okay, when you open up the textbook, you'll find the first module is talking about the country risk, and if you read this learning objective, they're talking about several factors. Okay, so before going to those factors, I have explained you what is country risk and why is it important. But they've given you those factors here itself. Okay, we're going to be getting into the details now. First of all, what exactly is a country risk? Now think about like this. Suppose Amit, our student, is a very big investor. Okay, he's working for a hedge fund. Now this hedge fund is planning to invest into an infrastructure project in, say, Zimbabwe. Okay, now before investing, they will obviously look at what are the chances that my project will get stopped in a particular country. Okay, what is the political risk, what is the impact, how the economy of the country is working, because I am going to invest huge amount into that country, and if whether I'll be able to get my money back, whether I will have the protection on that asset which I'm creating in that particular country. Okay, so as an investor, he's thinking like that, right? Now I give you an example of a hedge fund, which is an institutional investor. Okay, now think about John. Okay, a student, he is a normal retail investor. He is buying a stake of a particular company, and that company basically has a lot of projects in Zimbabwe. So he's indirectly getting impacted because he's buying some stake into some company, and that company is operating into that country. Now tomorrow, if there is any, suppose, civil unrest, or suppose any war that happens in that particular country, the shares of the company which I am holding will go down. Okay, because the revenue will get impacted, right? So as an investor, I will get impacted by this country risk either directly, this is related to the hedge fund example, or indirectly, which is the example of John. Okay, now when I'm saying country risk, it's a broader term. Okay, within country risk, how does the country risk comes into effect? Okay, there can be political risk. Okay, there can be political instability. Okay, so a lot of examples of this which has happened in the past. Okay, for example, Libya. Okay, whoever was a dictator, okay, he got caught, he was killed, a lot of things happened. So there is a lot of political instability, that who is going to be the next, either a dictator or whether there is going to be a democracy. Okay, so whenever there is instability in a country, okay, or a policy change. Now what is this policy change? Suppose a new government comes in and they're cancelling all the rules of the previous government. That is also instability, which is connected to the political risk. Why? Because I am an investor. Okay, suppose Madhav, our student, he is an investor. He has put some money into a particular country, following the rules and regulation of that country. Now that entire rules have changed. So he is facing a double cost because he has to follow the new rules. He has to file for a new application, all of these things, right? So that is a political risk. It is not just about the instability, but also if there is constant change in the policies or rules and regulation, then the investors or business will not be able to operate. Okay, that is the first point. Okay. Second point is a legal risk. Now, what is meant by weak legal system? It is like this: you've purchased a land, okay, but there are some gons, or there are some builder or somebody who has occupied that land. Now you cannot vacate that land, you cannot do anything on that land because somebody has occupied it. When you go to court, it is going to take 20 years. Okay, so this legal system is very weak. There is no property right. Okay, then what will happen? People will misuse because there is no strong rules and regulation which has been followed. See, there's a difference between having the rule and rule being followed on the ground, right? So when we generally say weak legal, when we say legal risk, it has both the aspect. Okay, the legal system itself is so weak that they're not creating new rules or policies, and it is not getting implemented on the ground. Okay, corruption, unethical practices. Okay, so if suppose I'm operating in South Africa, okay, and in that country, suppose there is a lot of political corruption happening. Okay, and if I want to start out with some project, say an airport, okay, I'll have to spend a lot of money just to give it to some people from the political party. Then that is a problem because my overall cost will go up, okay, and I will not be able to provide good service, right? So all of this impacts the business as an environment. Okay, I'm taking a short pause. Okay, till this point, any query, any confusion? Any query, any confusion? Right? Now, very simple logic. See this point now. Financial market innovation. What is this? If you go 15 years back, how much easy was it to invest into US stocks? Okay, right now there are a lot of apps which can help you to do that. InMoney is one of them, right? There are other apps where you can just put INR and you can directly, using INR, you can purchase a stock of a particular company like Apple or Google, right? It will automatically, you will convert the INR to dollar and you will be able to purchase. So the way you are purchasing things, or you are getting an exposure to the global market, previously it was not easy. Right now it is easy, it is cheaper for you to get an exposure. It is easy for you to now buy a property in Dubai, right, or buy a property in US. Previously it was not that easy. Okay, so because of financial innovation, new products are coming, which is making it first of all easier, then cheaper for you to get an exposure to an asset in a particular country. Okay, very good example is exchange traded fund, ETFs. Okay, there are many actually. Okay, so suppose there is an ETF of, say, global stocks. So when you're purchasing an ETF, you're indirectly purchasing a pool of global stocks. Some stocks from France, some stocks from UK, some stocks from US market or European market. So what is happening? You are sitting in India, you're buying an ETF which is getting invested into global stocks. So you're getting an exposure. Okay, simple. Next is, there are a lot of other products, like for example, ADR, American Depository Receipt. Okay, think about it like this. Everybody focus, huh? Nitin, focus. Okay, over here, if for example, there is a US investor, he wants to buy stock of Infosys. Let us assume Infosys is not listed in that country, it is only listed in India. Now an US investor, if he wants to buy stock of Infosys, he'll have to first open a demat account and all of that process. Okay, he'll have to transfer money and then he can buy the shares here. But by using American Depository Receipt, because these ADRs are listed in US and these ADRs are based on stocks of Infosys. So a US investor can directly buy that ADR and indirectly he's getting an exposure into a foreign stock, which is Infosys. Okay, so there are now variety of tools that are available which can help you to get an exposure into a foreign market far easier and at a very low cost. Okay, far easier and at a very low cost. Okay, this is the first part. Okay, because when you open up the textbook also, the first paragraph is basically talking about that. Okay, now we'll be entering into what are the key sources because of which you as a company or you as an investor are facing the country risk. Okay, very simple, very basic. Okay, risk exposure is not same for every country. Now this is logical. If I'm going to invest into US market and if I'm going to invest into an African country, the risk is different, right? In US, a lot of things are very structured. There's proper rules and regulation that has to be followed. In Africa, in certain countries, there might be a situation where things are not structured, and because of which I might face a problem. So every country is different because of the political scenario, because of the geographical scenario, okay, because of history. The situation is very different. Okay, different countries have different level of risk and different type of risk. Now certain countries are politically unstable, okay, but certain countries are politically stable but the legal system is not very strong. Okay, everything is fine but there is no protection for you as an investor, right? So all of this is going to impact the country, okay, or impact the investor. So look at this example. Investing in US company like Apple, okay, for you as an investor the risk is low. Why? Because US is listed in Apple is listed in US. Okay, you know that it is going to follow all the rules and regulation of Federal Reserve, right? Political risk for that particular country is very low. Okay, even if you face any problem as an investor, it will be sorted out. But if I'm going to invest into a developing country like Brazil for example, okay, the risk is slightly higher because it's a combined effect. the government might not be stable, the legal system might not be that strong, all of this. Okay, so I'm just taking a quick pause before we enter into the key risk. Okay, quick pause, read till this point. Vikas sir, answering to your query, what is ADR equivalent for Indian investor who wants to buy US? There is GDR, okay, similar to that, global depository receipt, wherein you can get exposure to any global company. Okay, but I don't think so in Indian markets these instruments are listed. Okay. I have answered your query. Okay, Vikram sir, Vikas, Peta, okay, all good. Now this is slightly basic, huh? Slightly basic. Okay. Now we are entering into the key source of country risk. Now, in the exam, okay, what they can do is they can basically give you a table which has 3-4 countries, and they might give you some indicator. Okay. Now the risk that we are talking about, there is one is economic risk, then there is legal risk, likewise. So what they will do is they will give you 3-4 countries. Okay, and for each country they will tell you what is a economic growth indicator, what is the number for legal, what is the number for political, something like that, and you have to choose where you have to invest. These kind of questions can come. Okay, so suppose they are writing that okay, economic growth is very high in country A but very low in country B. So what is the impact for you? That you need to understand. They might not directly ask you a straightforward theory based question. They might ask you as an investor, you have to take a decision. Okay, I hope everybody is clear. Look at the first part. Okay, look at the first part, economic growth and risk. Now over here what is happening, see, very logical is that if I am operating in a developed country, okay, the factors which impact any business, okay, is stable. Okay, it's very stable. So and also the economy will grow also at a steady pace. For example, in Indian market, okay, the economy is growing at 7-8% rate. There is rules and regulation with respect to SEZ, with respect to taxation, everything is clear, right? So economic growth becomes very important for any company, because if the country is growing, I will also grow, right? So if you're operating in a high GDP growth, okay, it's actually a good sign, because then what is happening, there is action in the market, and because there is action in the market, I will also be able to participate into it. Okay, now high GDP growth rate is a good sign, but if it is mostly due to inflation, real growth is less meaningful. Now what is this? Okay, now just I'm taking a step back. So when you look at, suppose there is a 10% interest rate in the market. This is basically nominal interest rate or nominal rate. Out of that 10%, let us assume, okay, say around 6% is inflation. Then the remaining 4% is the real growth or real rate. So in reality, what is happening? You're looking at 10% interest rate in the market, but out of that, 6% or 60% is coming from the inflation. What is inflation? The value of the money is actually going down. Why? Because for say 100 rupees, you were able to buy one apple previously. Now you're not able to buy the entire one apple. You have to pay a higher amount. That is because of inflation, right? So when what they are highlighting in this slide is that if you look at the growth of the country, okay, because we calculate GDP. Okay, so if I go back, then that's why we have mentioned real GDP, because GDP can be calculated in nominal terms and also in real terms, because a nominal term has the inflation part. Because suppose I'm producing one machine, okay, today the machine price is 100 rupees, okay, but next year the price is going by 110. If I'm going to calculate that, okay, I produced one machine of 110, my GDP will be higher, not because I produced more, but because the price has gone up. Okay, so when you look at nominal GDP, okay, it has the inflation effect, but when I look at real GDP, we are adjusting for inflation, and we are able to understand in true sense whether the country has produced better or less as compared to the previous year. Is everybody okay on this concept? Nominal and real GDP. Nominal and real GDP. Rahul, answering to your query. Sir, impact should be on risk factor or as per profitability. What should be logical thinking here if not mentioned in the question? It is more about the risk factor. Generally, the questions will come in the terms of risk factor, not profitability. Okay. Let us go to the next part. So I've covered till this section. Okay. Economic cycle matters. Now, what is this economic cycle? It is like this. Economy is going up, which is expansion. For some time, it will be an expansion, then it will come down. Recession, again it will go up. So that is economic cycle. Okay, that is economic cycle. So this is your expansion. Okay, this is your recession. Expansion and recession. Okay, developing countries often see large decline in real GDP during global recession. What does it mean? So when 2007 crisis happened, okay, US economy was going down, but there are a lot of smaller economies which are dependent on US economy. There are major businesses exporting to US, like for example this Mexico. Okay, now what will happen if tomorrow there is nobody purchasing in US market? Whoever are the producer in Mexico, they will not be able to get the business. So what happens whenever there is recession? The developing countries who are dependent mostly on developed nations, their economy will take a larger hit. So they have given you an example. Mexico, they saw 4.7% drop in their GDP as compared to only 2.8, which is US. So US being a developed country, what happened? They also got impacted, but the impact was lesser. Okay. So economic cycle matters in the sense where you are sitting as a country. Are you a developed country? Are you a developing country? Okay. That will also tell you how the recession is actually going to hit you. Okay. I hope everybody is good. This is the first factor we have covered. All good. Sahil, Subita, okay, Jason. Any question in the exam will be related to current affairs? No. No. Related to what you have read in the content. Okay. So next is political risk. This is a very interesting topic. Okay. Now the first thing that they're talking about, okay, I want you guys to mark this a star. Okay, continuous versus discontinuous policy. Okay. Now they have given you two examples, two references, democracy and dictatorship. Okay. Now there are various examples of dictatorship. Kim Jong-un, North Korea, right? And democracy is India. Okay. So what happens in democracy is that if you read the lines up, political changes are often which is continuous, but the changes has very small impact. Okay, small impact. Now why changes are happening often? Okay, so it is like continuous and low impact. Changes are happening continuous, but the impact is low. Now why continuous? Because every 5 years the government might change. Okay, in India last 10 years the government has not changed, but there is a possibility, okay, that because there is election happening, the government can change. Correct? So there could be a situation that a new person will come, new party will come, but the impact will be small, because very rarely they will be able to change everything which the past government has done. Okay, so impact is small and the impact will be slowly happening even if it happens. Okay, that is why we are mentioning democracy as continuous risk, okay, but smaller risk. Okay, when we talk about dictatorship, okay, the risk is discontinuous. Why discontinuous? Suppose if I have a good relationship with Saddam Hussein, who was a dictator of Iraq. Till the time he's in power, there is no problem for me. But the moment he goes out of power, okay, then the risk is very high for me, because US will also search me. They will also try to find me, right? So what is the issue with dictatorship or authoritarian? Till the time you're in good books of the dictator, or till the time the dictator is available, okay, there is no change in your status primarily. Okay, so it is discontinuous. Till that time there is no risk, but the moment the change happens, the risk is very high. Okay, there can be a sudden and abrupt change which can impact. Okay, so democracy and dictatorship. Okay, now as an investor, lot of companies, they prefer to invest in an economy which is dictatorship. Why? Because there is only one person or one family who's going to take the decision. You do not have to get an approval from so many people. That is also a thought process. Okay, I've completed the first section, which is nothing but your continuous versus discontinuous policy. I'm now moving towards, within the political risk, there is corruption, right? What is corruption? You have to pay something to get your work done. Now think from company's perspective. If I want to start a plant, I'll have to pay. Now all of this is an extra cost for me to operate in that business or operate in that country. Do you realize it's kind of a hidden tax? Okay, which I was not aware till the time I entered into the market. Most of the time, okay. And because there is a hidden tax, what will happen? The profit will be low. Investor who is invested in my company, the returns will be low, right? So automatically both of these things will go down. It will impact the company's profit and hence the investor will get lesser returns. Now the bigger problem with respect to corruption is, suppose if I'm a US company and I'm operating in say South Korea, okay, and I paid some kickbacks, okay, in South Korea, and suppose that Federal Reserve identified it or some regulator identified it, US regulator, I can face sanction, okay, because I am engaged into these activity, correct? So there can be legal troubles if I get caught bribing, and a lot of big banks have faced this in the past, okay. And that is why if you are a multinational organization, you have to be cautious of what is happening in terms of geopolitical situation, how it is going to impact you. For example, you wanted to transfer some money to Iran. One of your customer, you're a bank and you wanted to transfer it to Iran, but because of sanction from US, you cannot do that. Similarly, you cannot directly transfer money to Russia, right? So all of this is going to impact, right? So Transparency International tracks corruption globally. So they will come out with ranking, which are the top 10 countries who are most corrupt and all of that. Everywhere you'll find that. Okay, I'm going to take a quick pause. Any query on this section? But why do an investor invest in a dictator-backed country? Because risk is high, definitely, but the returns will also be high. Na? Think about this. If you get an opportunity to own a gold mine in a particular country and there is no restriction how much you want to extract, if you do it in US or any other country, there are rules. You cannot extract above a certain level. So companies do think about that. I'm not saying it is correct, right or wrong. Okay, what I'm trying to highlight is they have to face only one person. Okay, and the rules and regulation can be as per your requirement. Correct, Vikas? I've answered your query. Legal risk. What is legal risk? Okay, 1 second. I think so. There are two more points which is not covered here. 1 second. Okay, there are two more points. One is your which is not covered over here. You'll be able to see that in the textbook. I think so. In the slide, it is missing. I'll add that separately. One is with respect to if there is any, suppose, see, whenever you are operating into any country or any location, okay, if suppose there is law and order issue, okay, that there are two costs that you will be facing. First is, because there is law and order, you will have to make sure that there is security available to your staff, to your machinery and all of that, right? So you need CCTV cameras, you'll have to purchase insurance, you'll have to buy security, right? Secondly, if suppose any of your employee gets hit or get impacted during that period, okay, or in that location, you'll have to compensate him, you'll have to take care of him, you'll have to take him to hospital, you have to pay the bills. Secondly, you will have to also basically make sure that you give him some compensation, right? So that could be one problem if there is any law and order related issue. Everybody with me? Right? There could be a situation like that. Next, there is one more small problem, okay, which can happen, which generally is related to political, which is nationalization and appropriation risk. Nationalization means tomorrow, if suppose a country comes, the government comes and says, oh, your company is doing very good, we want to nationalize it. Okay, a lot of banks were nationalized. I think so in 1970s, a lot of banks were nationalized. Okay, What does nationalization mean? The government will say that this is government company. We will buy the stake. We'll pay you the amount, but the amount that you might get is not a fair value that ideally you should get. But you have to give the company because it's a government rule now. It's a political requirement, right? So that is also a bigger risk, nationalization. Second problem could be connected to that is appropriation. Suppose government goes back into the history and change the rules and regulation. Okay, suppose they go back 5 years back and say I'm changing the corporate tax from 25 to 30. So 5% extra you'll have to pay on all the profits that you have made for the past 5 years. This is going to create a lot of confusion, right? So all of this is also going to impact. I hope everybody is with me till this point. I think those 2 points are not covered. So I've explicitly highlighted that. Okay. We'll now go to legal risk. Okay. What is legal risk? Primarily how the legal system works. First is that whether the judge's appointment that happens, is there a formal process to take care of it? Okay. Because if suppose the entire legal system is very weak, okay, a ruling party can immediately hire or get somebody as a Chief Justice of India, for example. There is no due process, for example, or they can change the judges in the court because there is a case against their own person. So legal structure has to be very strong. Okay. Second problem is how fast they are taking decision, how fast the legal system is taking decision. Okay, because if there is a weak or slow system, investors will lose money, right? So there has to be a proper approach in which the litigations are getting resolved. Okay, in terms of property right, a good legal system protects who owns the property, correct? Now this property could be your intellectual property also, not necessarily a physical property. A bad system means you have to take your asset unfairly. What does that mean? I will have to use other methods. I cannot use legal methods because legal system is very weak. So I'll have to use other methods to get my property. I hope you understand what I'm saying, correct? If the system is bad, so I cannot rely on the legal system, correct? Next is dispute resolution, right? Suppose tomorrow I had a fight with Rahul, right? And we go to a court, and if the dispute is quickly and fast resolved, we both are happy because the legal system is working fine. But if the entire dispute is taking 5 years, 10 years, what will happen? There's a huge risk for me and for him also as a business when we are operating into this country, right? So for that much period, we'll have to go to the court, we'll have to pay the lawyer's fees, the legal fees. All of this is going to hit on our profit, correct? So dispute resolution has to be fast. The property right has to be clearly followed on the ground also. Okay, this is the basic aspect of legal risk. Now, when you read the textbook also in the last part, they've given you some information, they've given some ranking. That is not important. For example, this global ranking, North America, Australia, they have very strong legal system, but Latin American and Africans do not have that. That is just for information. They will not ask you this specific information primarily. Okay. Countries ranked as least corrupt also have a better property protection. So there's a connection in the previous part and this part. Okay. Now this you can mark as star. Okay. Now in the table, okay, they have given you what is a country's ranking in corruption index. Okay, and they might, from that point, they might connect and say whether you will buy a property into this in this country. Why? Because there is good property protection, right? Why? Because the country has low corruption. So they can connect the dots like that. Okay, so when you're reading, you should be able to understand those lines explicitly. Okay, so link to corruption, please mark it as star. Okay, any query on this legal system point? All good. Next is economic structure, how that country is actually operating in terms of money. Okay, how that country's GDP is growing. Okay, now if we look at India, so if India has agricultural business, service sector, IT sector, banking, the country is getting taxes from variety of sectors. It is not dependent on one commodity, one sector like that, right? So how diverse is the economy? Okay, and what is the reliance on one particular industry or one particular product? Like for example, Middle East, some of the countries are more dependent on oil. If you are dependent on one product like Venezuela, it is riskier because if tomorrow the oil prices goes down, which happened, what will happen? Your government will not be able to earn anything, and automatically it will impact their growth, right? So drop in the oil price will automatically hit the economy. There are countries who are dependent on tourism. So COVID had a big impact. Sri Lanka is a very good use case for that. COVID had impacted their tourism. Then there were policy issues with respect to agriculture also, which created that problem. Okay, so if you as a country, you're diversified, your source of income is diversified. So if one sector goes down, one economy, one part of the industry goes down, you're still not impacted because your economy is vibrant and it is diversified into different areas, right? So diversification is much more safer. So if you look at China, India, Brazil, they are more diverse economies. Okay, and even if there is a smaller impact, it is not going to impact the long-term sustainability of the country. Okay, very simple, fair point. Now, what they have done is they have connected the Michael Porter's structure, which is this economic structure part, with respect to competitive advantage factors. Now, Michael Porter has given a lot of these theories, okay, which are widely used in the industry. Okay, so Porter's 5 force model is also very famous. Similarly, this is the competitive advantage factor, which we're going to be talking now. Because sir, answering to your query, diverse means they are not dependent on few sectors, right? They have multiple sources of growth, multiple sources of revenue, right? Factor condition. Now, what are the factors? Certain countries has a huge competitive advantage like China because they have a skilled labor in manufacturing and at a very low cost. Okay, US has a capital advantage. They have money available. So the factor of capital is widely available in US as compared to any other country. So if I want to start a business, capital is easily available, right? But in China, I want to start a manufacturing, that is possible and faster because the labor is available very easily and cheaply, right? What is the demand condition? Demand for a particular country's goods. Like for example, if you look at any, suppose mangoes, okay? Mangoes grown in India are widely sold outside. So what is the demand for country's product outside? For example, German watches or German cars, okay? So they have a good demand outside Germany. So when you have a product which can give you a good advantage because that product has a huge demand outside, so automatically your economy will become stronger, okay? What are the related industries? Supportive industry. What does it mean? So think about like this. If, for example, I want to start out a Tata Motors manufacturing facility, okay, which is going to produce car. Whether I have supporting infrastructure. What is supporting infrastructure? Whether I have a raw material provider, okay, and different parts which will go into the auto part. So there is an auto ancillary industry, okay. Whether I have auto ancillary industries surrounded my plant or closer to my plant, because then I will be able to produce faster. Similarly, in any country, if I have a main product, whether I have supporting industry available or not, or whether I'm dependent on import, that is also important point to consider. Okay, right? Firm strategy, structure, and rivalry. Okay, now look at this. How businesses are run. So if you look at, say, whether there is monopoly, duopoly, okay, or perfect competition. Monopoly is where there is only one company. Nobody else is able to provide the service. Duopoly means there are two companies. Okay, they are the primary people who are operating. Okay, there can be more structure like that, but how the entire industry is working, operating. Okay, for example, if you look at fast food chain, so you have McDonald's, Burger King, so many different brands who are operating. So there is no one person who is dominating it. So what is a firm's structure? Okay, or a structure of the economy, or structure of the sector? How strong is the rivalry? See, when there is rivalry, what will happen? They will try to cut down on each other. So if company A is selling at 100, the second company will sell at 99. They will start selling at 98. So automatically what will happen? The prices will go down, but the smaller companies, they will not be able to operate. And they will move out of the section or the economy, right? So if you look at your telecom industry in India, previously there are so many companies. You had BPL, you had Virgin, so many companies operating in India. Aircel. But all of these companies had to go out. They got either acquired, merged, or closed. because it became very difficult for you to provide the service to the customer at a very low price. Okay, I'm taking a pause. Read these pointers and let me know if there is any confusion. I hope everybody is doing good. Let us move forward. When you're looking to invest into any foreign country, you ideally look at how the legal system works, whether the country has a diverse economy, okay, whether a particular country has a particular competitive edge in the way they are operating. For example, Middle East has oil, which no other country ideally will have, right? So that is a competitive advantage. They will be able to provide these raw material at a low cost, okay? And all of these will have an impact on how the country risk is calculated for that particular country. So this last line is just a closing remark on all the risk factors that we talked about. Okay. Look at the next part. How do we evaluate the country risk? Okay. Now there are multiple providers of providers of services, okay, in the market who try to analyze what is the country risk for each country. Okay. So they will come out with the rankings likewise. Okay. So few of the service providers. Okay. First is this one, PRS. Now there are 4 of them, but in the exam explicitly they don't test you that how does PRS identify a country risk. No, over here they have given if you read the textbook also, they have given you the details, but very unlikely that they might ask you a specific question from that. For example, very difficult that they might ask you how many variables PRS is going to use to come out of the scope. No, very difficult. Okay, so what is the service provider doing? They are looking at broadly 3 type of risk, and based on these 3 type of risk, they are coming out with a score, and score tells me which country is actually better. Okay. Next, this is basically a rating agency, but there are media outlets like you have Hindustan Times, all of that. So the media outlet like Euromoney and Economist, they also come out with the section. Now I'll just go to highlight, mark it as star. So Economist is taking a survey of economists across the country, across the globe, and based on that survey, they are coming out with a report that which country is slightly risky, which country is less risky. Now the interesting aspect over here is because who is filling up the survey? Economists, not investors. Okay, not anybody else. People have money. They are economists who are doing it. So it is more from the country investment perspective. What does it mean? If government of India wants to invest into Afghanistan, so this logic will work. What does economist think? Not a normal company or a normal investor. Okay, so remember that I'm marking it as star. Look at this. This is also, I hope you must have seen Economist magazine. Have you seen that? Anybody? Right? So they are taking some factors to analyze. Okay, there are many more actually. Subita, there's no need for you to remember the 22 variables. Okay, the variables are nothing but factors which impact the country. Okay, yes, World Bank also has a lot of data on basis of which they tell that how a particular country is operating. Okay, what is happening in the particular country. Okay, currency risk. What is sovereign debt? Pakistan has taken a lot of debt. Sri Lanka has taken a lot of debt. India has also taken. Okay, so how much huge debt a country has taken? Okay, so if the debt is very high chances that you will default because you would not have money to pay. Correct? So they also look at that risk. Okay, because answering to your query, economist perspectives are more, economist perspective is more from the government perspective, government side. If I want to build up a dam, build up a project in a particular country, what are the chances that I will get my money back? Okay. not from the risk mitigation logic. No. Okay. Now, the interesting aspect is also this World Bank, because they also have six key areas of country risk, okay, where they try to analyze a particular country. Now, when you look at that, okay, look at this accountability, which means whether in a country, okay, if suppose if there is a corruption in, say, for example, Olympics team, there is a sports minister who is actually responsible for it, and he will be replaced, right? So corruption, how strong is the government, how effectively they are putting policies, all of this they will take into account, and they will come out with a score. Okay, but the main issue is all of these players in the market who are providing you with the country risk and their score, everybody has a different approach. Okay, somebody is taking 22 variables, somebody is talking to 400 economists. You can see the difference, right? So what is the challenge that you face, okay, when you are operating, when you are looking at country risk? All of this is important. Huh? Mark this as double star. There's a section in your textbook also talking about it. The first problem, okay, Mansi, what is the first problem? There's no standardization. That means if I'm looking at PRS, political rating services, okay, you see that Indonesia is very good at a very high rank. But when you compare it with Euro Money, the rating ranking is bad. There is no way you can compare that how exactly the country is performing in 2-3 different rating scale, because every approach or every system has a different logic of calculating the risk. Okay, somebody is only focusing on political, somebody is focusing on the economic front. Okay, so not every part of the score is relevant to every. This is the second point. Huh? First of all, there is no standardization. Second, think about this. If I'm looking at World Bank data, I am more concerned about political stability, but the score is a combination of all of them. So it will not give me a good answer. I will not be able to take decision on the basis of that. But because I wanted to focus on political risk, but the answer that I'm getting is combination of all of these factors. Correct? Okay. So not fit for all part. There is no standardization because different services have different method, different way of calculating. So there is no direct comparison which is going to happen. There's no direct comparison between, okay, I got a ranking from Euro Money this much and I got a ranking from economics this much. There's no clear cut comparison. Okay. So these are the first two problems which you will ideally face. But look at the last one, and I'm marking this explicitly as star. Whatever ranking you're getting, okay, that is basically, you cannot use it as a comparison part. Okay. So it is more like, it is not giving you a correct difference between two countries. You have to think it like this. There is no correct difference. I'll give you an example. Okay, suppose there is country A, okay, which has got a score of 51. Okay, country B has a score of 71. Country C has a score of 91. Let us assume high score means good. Okay, so we cannot say that country, you can see the difference between both of them is 20, and over here is also 20. Okay, we cannot say the way country B is better than country A. Similarly, country C is also in a similar way better than country B. We cannot say that. Why? Because the difference is 20. Do you realize it is only a ranking? The score that you're seeing, it only helps you in ranking that, oh, country C is better, but how much better we cannot say. Okay, how much better we cannot say. It does not tell you what is the risk level of the two countries. Okay. There's one more example connecting this. Read this point. Suppose a country which is ranked 70 by economists is riskier than somebody who is ranked at 35. Now over here in economists, lower rank means better. Correct? But we cannot say that because you have 70 and somebody else has 35, you're double the risk. No, we cannot say that. The 1735 only tells me which country is more risky, which country is less risky. But how much more risky, we cannot say that by only looking at the numbers. Okay. Yes, there is some underlying level of risk basis which you are trying to identify. Okay, that which country is more risky, but you cannot just say that, okay, the level of risk which this country A had country B, which is at 70, is double that risk. We cannot directly say that, no? Correct? Because I've answered your query. The core does not define the methodology. No, it is not like that. It is not like that. The intention of this score or this ranking, okay, is to give you only a rank. It is not a proper perfect score. Do you realize that? There is a difference. Okay, for example, you got rank 1, okay, and somebody else got rank 2. So it does not mean the way you are better than rank 1 in terms of the difference between the marks. Okay, the rank 2 is also in a similar way better than rank 3. No, the difference can be very high. I hope everybody is clear. The last point, difference between a ranking and a score. All good? So just a connecting point, say US, I think so, has around $30 trillion economy. Okay. China, I saw this 2 days back. But if I compare a common risk factor for ranking between two country A and B, then judgment can be made. Yes, but the scoring that they have done, they should have that, they should give the proper detail, now which common factor, because see, if I'm looking at 35 and 70, okay, there might be 10 factors which are impacting that, and you're only looking at 2 factors, right, Vikram sir? So it is not possible for you to find out that 2 factors explicitly and say, oh, the reason for the difference is these 2 factors. Very difficult. Okay. China, I think so, has 18 trillion or something. India is at 4th number now. How much is India? 4.5 or 5 trillion? I don't know exactly. There's one more country, na? In between, there is one more country. So now see the difference. See, this is rank 1, this is rank 2, there is rank 3, and there is rank 4. But the difference between both of them is there is a wide gap. Because in Germany, no? So India will be able to cross Germany in few years. They will be the top 3rd country. But the difference between India and China is very huge. Similarly, India and US is very huge. So you cannot make a direct comparison. You can rank, but the difference cannot be highlighted at the same way we are. There's a gap is same. We cannot say that. Okay. Let us go to the question section. Everybody, look at this question. Now, purposely, I have tried to create a question or the structure in such a way that there is a scenario. So you have to read. There could be a lot of unnecessary information in that scenario, and you have to come out and find the answer. Okay. Chalo, start reading the question. Read all the section. So Ravi is working for a large portfolio manager working for a large foundation. Foundation has huge money, they will be investing, and they are planning to add certain countries' sovereign bond into their fund. His decision has raised few eyebrows because he's looking at sovereign bond of a country which has been governed by authoritarian regime. That means dictatorship. So he's investing into dictatorship. When you read the entire question, they are saying which of the following statement support his decision to invest. See, this is wrong. Is this, see, authoritarian government often exerts strong control over government institution, reducing the likelihood of corruption. No, this is wrong, because chances of corruption are huge in your authoritarian system. So wrong. Okay, look at the other options. In the majority of authoritarian country, private property rights are generally well protected, and disputes involving property ownerships are typically resolved quickly and efficiently. Now, is this one of the main reason for you to invest? Think, you'll have to read from that perspective. No, this is only about, see, legal right, but legal right might not be the biggest factor, okay, for investing. Okay, if you read, defends his strategy by saying political risk. So if you read that, it is highlighting political risk. Look at B and C. While authoritarian face heightened day-to-day risk compared to democracy, the risks tend to be less severe overall. And see, this is straight away wrong because authoritarian dictatorship has discontinuous risk, the risk is very high. Answer is A. Now, this might seem, when you read the statement, it might seem though it is not correct. But when you read it properly, they are saying because there is only one person, whatever debt they have taken, they will be end up paying back. There's no political change, and then there is no political change in terms of election. The policies are more or less stable. Okay, when you read the answer also, many investors, including Chaudhary, believes that political risk associated with sovereign investment is lower in authoritarian regime, primarily because the government typically exhibit a high degree of political stability and predictability. Okay, and lesser policy change will happen as compared to democracy, because every 5 years the country is going to change. So answer is B. Okay, look at the next question. Read the entire answer properly. Sorry, all the question text properly. Now, when you read the entire section, okay, they've given you a lot of information about this, and this entire part. When you read, now you realize it is not that much important. Okay, it is a lot of unnecessary information. The main part is while looking at the sovereign risk, they are taking the insights of hundreds of professional economists. This is covered in euro money. Okay, this is covered in euro money. So that is one thing that you need to remember. Okay, over there it was 400 economists, correct? Right, I'm going to take a pause now. We have completed the first module. Okay, now we are entering into the second module of the chapter, where the focus is on looking at sovereign defaulters, that the country has defaulted. Okay, now when a country is going to default, it can either be a local currency on which you are defaulting, that means you have taken a debt on local currency, or else it can be foreign currency. So Indian government has issued debt or loan in USD. Okay, that why it is needed? Because I need forex reserves. So I have issued a bond which is in USD or which is in euro. That could be the case, and governments do that on a continuous basis. Okay, so what is sovereign default risk? Simply, country does not have the ability to pay. Okay, they cannot repay the debt, neither the principal and the interest. Greece was facing this problem. They did not have money to pay the interest component also. Okay, now this debt can be a domestic currency and foreign currency. Right, now think about this. If the debt is very huge, higher chances that the country will default, and it will increase the overall country risk. Very simple, very logical, right? Now they have given you the details of both the foreign and the local currency debt. Now I want you guys to focus and read it properly. Okay, what is a foreign currency debt? You have borrowed in currencies like USD and euro. So Indian government has borrowed in USD and euro. Okay, now the interesting part is if I am not having enough USD to pay back, I cannot print it, right? I do not have the ability to print. In local currency, I can still print and I can pay you back. There are implications for it, but in foreign currency, I cannot print. Okay, so that is a big problem that you might face if you're taking a debt in foreign currency. But then why do you take it? Because you need to have forex reserves to manage import and export as a country, right? What is local currency default? You are defaulting in INR. Okay, but the easiest thing that you can do is you can print the currency and you can pay back. But what is the impact when you're going to print currency? Jason, what is the impact? Lavesh, what is the impact if you're going to print the currency? Inflation. Perfect. Read this. Higher inflation. And when there is higher inflation, it is going to impact the businesses also. Right? That is why the printing is not an easiest solution available. Okay. Now, so this can lead to a default, right? So let us look at few examples. Okay, what has happened in the past. between this 2010 and 2016, 8 foreign currency default has happened. Greece was the latest, right? 2012 we saw a lot of default happened around. Portugal was on the verge of default, then Spain, a lot of these countries, right? It was a euro debt crisis. A lot of these government bonds were worthless now. Okay, so many countries started defaulting. Investor lost almost 70% of their investment. A lot of time we assume that the government has taken money, then it is safe. Not necessary. Okay, not necessary. So this is a recent incident that has happened, the 2012 euro currency situation. But historically, for the past 200 years, so many default has happened. So they've given you a number in the textbook also. They've given you this country has defaulted 6 times, 7 times. It is very normal for them, right? Especially South American countries. Okay, they are facing bigger problems, right? So till now, till this entire sovereign default, any confusion, any query on this part? I hope everybody is doing good. Let us move forward. Now, local currency default. In the so local currency default is you're not able to pay back in your own currency. Okay. And in the history, there have been situations where the countries have defaulted on both. Okay. Russia defaulted and Brazil. This was a big event. Huh? Russia defaulting on its loan. Big event. Okay. So this is the basic concept of local currency default. Now over here, when you go forward, mark this entire section as star. Why would you default on local currency? Because you can still print, no? But the major problem is if you're going to print that, okay, currency debasement will happen. What is currency debasement? The value of the currency will go down, right? Value of the currency will go down. What does it mean? There will be more, suppose if we are talking about INR, so more INR in the market. Everybody has the INR. Now if suppose somebody wants a goods or a service, everybody has the money. So the price of that goods will go up because everybody has the ability to pay, right? That is how the demand and supply will get impacted. Okay. So printing more money will lead to inflation, right? So country has to take a decision whether if I'm going to default, I will not pay. This will increase the risk for the country. Plus next time when I'm going to borrow, the rate of interest will be higher, correct? So whether I want to default or whether I want to print more money and face inflation. So it's catch-22 situation for the country, right? The cost of default could be there because next time when you go and raise money, the interest rate will be higher. Or else if you print your own currency, the inflation will be at a huge level. And this can create huge problems, next level problem. You must be hearing about Zimbabwe or one of these African countries, they're facing inflation, okay, at a very high level. Okay. So historically, countries who are defaulting in their own currency, they were defaulting because they don't want to increase inflation. So this was one reason. Okay. Second reason was the currency union. Now Greece defaulted even though the loan was on in euro. But why did it default? Because they are not printing euro now because they are a part of eurozone. When you're a part of eurozone, you have European Central Bank which is going to print. You do not have the authority to print, right? So automatically what will happen, even though it is your own currency, because you're a part of that currency union, you lose the ability, okay, you lose the ability of fiscal policy, so not the fiscal policy, primarily your monetary policy. Okay. Now in India, RBI regulates that. They have the monetary policy. They will say what is the change in the repo rate and all. They will control the currency in the economy. Now over there, because you're a part of the currency union, you have given up your monetary policy rule because for all the countries, European Central Bank is taking the decision, right? So because of that, you're not able to pay back. And lastly, gold reserves. Now this was before 1971. Okay. Previously, the logic was that whatever gold you have, you can print that much amount of currency. That means what currency should be backed by gold. But then later on, the issue happened. A lot of developed countries, they do not have enough gold. So they changed it after 97. There was a Bretton Woods system that was brought in. And then after 1971, there was no need for you to have a gold to print currency. So what was happening before 1971? A lot of default happened because they did not have enough gold available to print. Because of the rules and regulation, they did not had the ability to print. Even though they wanted to, they could not. Okay, I'm marking all of them as star. Let me know if there is any issue. I hope everybody is doing good. Right? Now, how would rating agency default? Do you know that rating agencies rate countries also? Right? So, rating agencies, like for example, Moody's and S&P, they will give rating to individual country. Okay. I'm answering to the query, currency union. Okay. So, for example, you're a country, European Union country, like for example, Spain or Portugal. So, all of them, they follow euro as a currency. And who is printing that euro? European Central Bank. So, as a country, individual country, I cannot print euro. So, even though I want to print, I do not have the ability. I cannot pay my loan back, even though it is still in euro, because I do not have the ability to print. Right? I've answered the query. Right? Next, agencies will give rating for both. When they give rating to countries, local currency and foreign currency debt, they are giving rating for both. Why? See the interesting logic over here, in which you need to mark it as star. Local currency rating is usually few notch higher. So for example, if you look at India, okay, so if I'm going to look at local currency rating and foreign currency rating, okay, suppose local currency rating is say double A, and this is going to be single A. Single A is lower, huh? Okay, single A is lower. Now, why would this happen that the local currency rating is slightly higher than the foreign currency? Because in local currency, if you have taken debt, you have the ability to print and pay. There could be a problem of inflation, but you still have the ability to pay. So what they are saying, if a country has the ability to pay the currency, the risk is lesser, hence the rating is higher. Right? They can make sure that the repayment is happened. But suppose I'm talking about Greece. Greece, where you do not have the ability to print, then in that case, your local currency rating and foreign currency rating is going to be same. Right? Because they cannot print. So there is no extra advantage that you face when it is a local currency rating. Right? I hope everybody is good. Mark this as star. Okay, 1 second. Countries printing more currency resulting into inflation. That's why most countries default even if they have the right to print. Yes, that's correct. That's the right point. I hope everybody is reading till this point and everybody has marked this section as star. And everybody is clear, right? That this is an important point. That's why I've explicitly highlighted. Right, Prashant? Dayanand, Dhwani, right now? Sahil. Okay, I'm going to move ahead now. Consequences of default. Now, if you as a country default, what are the problems that you're going to be facing? Very simple, very basic problem that you're going to be facing. Next time when you go to raise money in the market, nobody will give you money. Even if they give, the rate of interest is going to be high. Right? So what are the default and their consequences? Okay, now in the historically what has happened is, I'm talking about 30 before 1950s, 1960s. If you do not pay a country's debt, they will do an attack on it. Right? So there are a lot of military conflicts that will happen, and this has happened in the past. Okay, So if country has taken the debt, they are not paying back, and they will attack and they will get their money back. Today, it is very difficult for an attack to happen. So what will happen? There will be a lot of sanctions. Okay, you will not do trade with that country. Okay, you will stop any business, any tours, travels, anything from that. So default usually follow economic difficulties. What is economic difficulties? Because they're interconnected. Okay, so because we are interconnected, you will find that the country is facing a recession kind of situation. No new companies are operating. They are opening offices in the country. Foreign investment has gone down because they are defaulted, right? And you can see situation of Sri Lanka to a certain level, and Pakistan, where there is issue with respect to foreign debt. When as a business you are not sure whether the government will survive, okay, they have enough money to survive, why will you open up your office over there, right? Very logical. So few of the example, Argentina in 2001 defaulted and they faced economic depression around that point in time. So if the government does not has the money and they are kind of in a process of defaulting, this might be a very good sign that there is a recession coming up in that country. Okay, so this is one point. Connecting point is very simple. Lot of loss of reputation. Next time when you want to raise money in the market, nobody will give you, right? Simple logic. If Madhav has taken money from me, next time if he asks me, I will not give it, right? And next is it is going to become more expensive. What is expensive logic over here? The rate of interest in the market will go up. So if you know debt, okay, government debt, okay, then you have to pay yield, interest, right? So that interest will go up, the yield will go up. Okay, next is reduced investment. Stock market will go down, bond market will go down, and very, very important, foreign investors will shy away. They will not invest in your country. So less foreign investment will happen. Okay, and political impact will be there. Opposition will say this government is not doing anything, so they will try to change the government, right? They will try to change the prime minister, president of that country. So the political instability can be there. Change in government will happen. There will be a lot of protests. Very logical, right? And very, very important is this economic downturn. Economic downturn. Okay, that is going to impact. The country will see lesser growth in terms of their GDP, in terms of the new businesses, new opportunities that are coming in the country. Okay, I'm taking a pause, asking you guys to read in this part. Let us move forward. IMF. You must have heard about this lot of times in news and all. Okay, IMF is giving loans to a lot of countries. One of the requirement is that they have to make sure the weaker economies they get financial support. Okay, that is why they are operating in the country, in the economy, right? They restructure their debt and they will put restrictions. So if my country is not doing good and it has taken a loan, and there's a next tranche of money that is going to come from IMF, IMF will say that we'll have to increase taxes, we'll have to reduce subsidy, all of this, so that the government should be able to generate revenue. Okay, so what is this austerity measure? Okay, this has happened in Pakistan. When IMF is giving loans, they are giving so many restrictions to them that you cannot, what do you say, you cannot basically, you'll have to increase the taxes. You'll have to reduce your spending cut. That means as a government, you have an operational cost to reduce that. Increase taxes. Now, and also subsidy can go. So because of which there could be possible social unrest in a particular country. In 1990s, when India faced this issue, they did not have foreign reserves available. So they had to go to IMF to get it bailed out. When they had to do it, so they also had a lot of restriction that as a country, you will have to liberalize. You cannot have a closed economy. And that is where the liberalization, globalization actually happened. Right? So IMF or basically any global body which is lending, they're lending to make sure that the weaker economies are sustaining for a longer period of time with their support. But they will have some restriction, something available in the section. So I'm going to take a pause, read till this point. Let me know if there is any confusion. I hope everybody is good. What are the factors which are going to impact your default risk? Answering to your query, Nitin. Why would World Bank give loan to Pakistan during war? See, there would definitely be a higher risk, but they cannot they cannot make sure, they cannot leave a country and make it fail. Okay, very difficult. So they will try to protect. Okay, they will try to protect. So this is indirect way through which global economies are supported. That is how it happens. Okay, factors influencing the default risk. Okay, describe the factors that the level of impact. See, what are the factors which are going to impact the sovereign default risk? Okay, countries defaulting on their loans. Okay, how does that plays a role, and how rating agency will also come into the picture, because rating agency, the moment you default, the rating will go down. Correct? So look at this. Debt to GDP ratio. I want everybody's focus. Okay, now over here, one important line which is there, which is this: debt to GDP ratio of any country is one of the important factor, but it is not the only factor. Now, what is debt to GDP? Okay, how much loan you as a country has taken. Now, when you zoom in, okay, this line would also be there. This line would also be there in your section. Okay, this table. Can you see Japan has around 240% of debt. United States is around 100%. What does it mean? As a percentage of their overall GDP, which is so many 30 trillion, they have taken so much debt, and it is very normal for any country to take debt. Why? Why? Because you need money, okay, to fund your infrastructure project, for defense and all of that. So generally, countries, they take debt. Okay, they take debt. Right? Countries do not have an equity the way companies can do it, countries cannot do it. So they will have to issue a bond to raise money. Right? So debt to GDP ratio tells me how much a country actually owns. Now higher ratio means higher borrowing, more debt burden, very logical. They will have to pay in the future. So countries taking debt now, your future generation you have to pay. Right? And it is going to be, because you are paying interest also, no? So it is going to be more costly in the future to pay. But this is not the only factor, because we see Japan, we see United States, India is also there. Huh? They are not defaulting on their loans. So having a high debt is one factor, it is not the only factor. That is one thing you need to remember. Okay. Look at this. Why would a country default? One of the strongest reasons could be social security commitment. So government is giving pension. So right now, Indian government has changed the rules for pensions, right? They are making sure that we do not have to keep on paying pension, and it is going to be a huge cost for the government. So pension, healthcare, a lot of developed countries, they have healthcare which is being given by the government itself, but government will have to pay, right? Right? So that is all social benefit that you have given. Higher the social benefit, more chances that you will end up defaulting, because you have made a commitment to the population, right? Tax base. If there are more people who are paying tax, more money will come to the government and less chances that they will default. Right? So that means there is more tax revenue. There is more tax revenue that you will find. Correct? That is the overall idea. More tax revenue. So if you increase your tax base, you know more people are paying your taxes, and so lesser impact in terms of the revenue loss for the government, right? And also, if you have a diversified economy, it is not dependent on one factor, one commodity, and that is also good, because more stable income more stable taxes for the government. Right? I'm taking a short pause, answering to your query. How do we assess Russia versus Japan in this table? Now, this table only talks about debt to GDP. Ideally, you should be looking at the rating of the country, okay, and difference between there's a concept called sovereign default spread, which we're going to be doing later. You should ideally look at the rating and the sovereign default spread, okay. Looking at all the both points which I have talked till now. I hope everybody is reading. Let us move forward. Political risk. Now, one of the important factors. Now, see this point. Autocracies, that means dictatorship, may default more often. Why? Because they're not worried about what is happening outside. North Korea, even if they have issued a debt, if somebody says pay, I don't want to pay, right? So they do not have any pressure from their own population that they will have to pay back the loan. So autocracies, their chances of default would be slightly higher. They can default more often, okay? But it is not necessary that every autocracy will default. It depends upon how it is operating also, right? For example, there are a lot of rule countries where there is a rule of king, okay, but they still have proper debt structure. They repay their debts and all everything. But North Korea is a different scenario, right? This is important. Mark this as a star. Countries with independent central bank. What is this? First of all, whenever government needs money, they will go to RBI to print the bond. The RBI will issue the bond, then the money will come to the government. Right? Now, suppose government is pressurizing RBI. Indian government is pressurizing RBI that we need more money. RBI will say no, it will create problem. Okay. So if RBI is independent or the central bank is independent, government will not be in a position to pressurize. Okay, because what government will say, I want to print more money because I want to win election and I want to pay money to my population. Right? This can create an economic issue. So if the central bank is independent, there is very less impact that you will face. Okay, very important point. Mark this as star. Implicit guarantee. What is implicit guarantee? See, when European Union faced problem, okay, Germany, which was a powerhouse, that was the only economy which was doing good. There was an indirect support from Germany that do not worry, Spain, Portugal, even if these countries will default, we will be supporting. So France and Germany, they were supporting. Similarly, when Sri Lanka defaults, India supports. Okay, so even though there is no directly written guarantee given by India, but everybody knows that India will support. Right? So that is why it is called as implicit. That is not an official guarantee. Okay, implicit. Okay, I'm taking a pause. Read this section. Hope everybody is reading till this point. Let us move toward the next part. Okay. Now, this is a summary. What they are trying to highlight is any country would default. It is a multifaceted factor. That means it is not just one factor which is going to impact. So there will be multiple factors which are impacting and leading the country to default. So the country might have a high debt level. Okay, they might have lower tax income. They might be dependent on oil. So many things, right? And that is the reason they are defaulting. Right? So whenever you are investing into any country, you would look at how trustworthy that government is. Okay, in the past, whether they have paid back their money. Okay, and what is the nature of the economy? If the economy is diversified, lesser chances of default. So these two factors are important. I'm going to mark this as star. Two factors are primarily important. Because even if the country, everything is happening good, but they do not have the intention to pay. Because whenever you give any loan to anybody, you look at two things. First is the ability, and second is the willingness. What is ability? Ability is covered with the nature of economy, whether they have sufficient revenue source. What is willingness? I have the money, but I do not want to pay. Right? Vijay, very simple case. So that is willingness, whether that person or the government is trustworthy or not. Okay? So I'm taking a short pause over here. Any query, any confusion to this point? Any query, any confusion to this point? Okay. Now there is one connecting dot over here with respect to local and foreign currency debt. Local and foreign currency rating. Okay. Now see, we have already said that when the rating agency is going to give rating, they will give rating for both, and the local currency rating is going to be higher. Right? Why? Because you can print your own currency, but foreign currency cannot be printed. Right? Now what they have shown you in the textbook also, historically they have looked at the data. Okay, and they have compared two things. They are looking at ratings. Say for example, AA. I hope everybody is aware about the general structure of the rating. Okay, AAA, AA, single A, triple B. Okay, till this point, what do we call it? Investment grade. That means very good rating. Okay, there is an invisible line. After that, there is double B, single B, triple C, double C, C, and then you have D, which is default. Okay, from here till here, it is a non-investment grade. I hope everybody is clear. Right? From here till here, it is non-investment grade. So now, when we are talking about, yes, so from now, when we are talking about this section, over here they are talking about that historical, when you're looking at historical data and we're looking at one particular rating, we are comparing what is happening in countries and what is happening in corporate. Okay, so at the top ratings part, which is AAA and AA, okay, there is near zero default, which is in countries. Okay, that means those countries are not defaulting, which is better than corporate debt, because corporate debt with AAA rating also are defaulting. So this is basically analysis of data. Okay, so they started with AAA and AA, and then they're moving to single A. Countries are worse than corporate debt. What does it mean? Countries with A rating, they are defaulting more often as compared to corporates with A rating. That is what the comparison is. Right? I hope everybody is reading properly. I'm going to move ahead. So we started with, basically what we are doing is we are comparing. Again, they're very unlikely that you'll have to remember this. They're just showing you a comparison. Oh, at the top rating, what is happening? How countries are performing as compared to corporate debt. Okay, so in the AAA and AA, countries are performing better. But when you look at single A rated countries, they're not performing well as compared to single A rated corporate debt. That is what they're highlighting. Okay. Similarly, they are also going down, triple B, double B. Okay, over here the performance is almost same. Okay, better, lower default for local currency debt. Now this is specific input that they are giving, that when you look at historical data, okay, the performance of triple B, double B rated countries is almost similar as corporate debt. Okay, so it's a comparison point. Okay, and one additional point that they've highlighted, that the performance is slightly better in a local currency default debt as compared to foreign currency debt. Okay, again, this is very specific information that you're getting from the historical data. Look at the next one, triple C rated and double C single C part. What is happening? Countries with higher foreign currency debt, they are defaulting. Okay, and local currency rate, the default rate is very low. So what is the summary of that point? The last point, this point, that triple C rated or single C rated countries are facing problem in paying the foreign currency debt. Facing problem in foreign currency debt. Okay, I'm taking a pause. I want you guys to read till this point. When local currency debt rated lower compared to foreign debt. Which one you are talking about? Amit? No, you don't have to remember this. This is just a reference of historical data. Amit, are you talking about this section? Triple C? So I'll answer it. When local currency debt rated lower compared to foreign debt. No, so there could be a situation. See, ideally your local currency rating should be higher. Okay, but there could be some exceptional point. Certain times local currency rating could go down below the foreign currency rating. This has happened for India also. Okay, Amit, but this is not a normal behavior. Some because of some event that might happen. Okay, what is rating transition? So this rating transition matrix will come, okay, in your chapter external internal rating. Okay, so there what does this? There is a proper matrix, and in that matrix it tells you if you're standing at say double B, what are the chances in the next 1 year you will go up? That means your rating will improve, or what are the chances that your rating will go down? Okay, so that entire matrix is available with the rating agencies. And based on that rating matrix, they basically try to calculate that what are the chances that the country will go up and country will go down. Okay. Countries generally, see, look at this, rating change is less frequent. Why? Because they very unlikely the situation or any big event will happen. For example, a war. Okay. War will not happen every single day, no? Right? Or say a big issue in the country. So generally the rating is stable. If there is an event, if there is big thing happening, then only the rating change will happen. Okay, then only the rating change will happen. All good? Till this point? I'm going to take a quick pause over here. Now there's one last section which is talking about sovereign default spread. See, whenever we are talking about spread, it is mostly the percentage gap. Okay, it is mostly the percentage gap. So how do we calculate this sovereign default spread? So I'll give you an example. Suppose we are looking at India's foreign currency bond. Okay, and that bond is in USD. It's a 10-year bond. Okay, it's a 10-year bond. Okay. Similarly, and because it is in USD, I will have to compare it with the US government bond, because US government is the main part who can print USD. Okay, so I will look at US bond, which is obviously in USD, their local currency, and it's the same 10-year bond. Okay, I will check what is the yield on this bond. Okay, I'm just taking an hypothetical part. Suppose it is 10%. Okay, and let us assume that this is 7%. So what is the spread? Spread is 3%. This is the sovereign default spread. Okay. So what I'm comparing, Indian countries, foreign debt in USD. So I'm looking at, okay, what is the US government's bond? Okay, same maturity tenure. And what is the yield of that bond? The yield of that bond is 7% and mine is 10%. So 3% is the gap. That is the sovereign default spread. Correct. Now I'll just show you one reference. So suppose if the amount is 100, the price is 100 of Indian bond, and the bond is giving a income, coupon, interest of $10. Okay. So the yield is going to be 10%. How come? 10 divided by 100. Now suppose if there is a huge demand for Indian bond. Okay. There is a huge demand for Indian bond. The price goes up. This income is going to be stable because the bond has a fixed coupon. Okay. So this will be 100, 110 and 10. What is the yield now? It will be calculated as 10 divided by 110. So the yield will become 9.09%. Similarly, if there is bad news about India, the price will go down to 90. From 100, it will go down to 90. Okay. Now, if I want to calculate the yield, it is this. And the yield is going to be 11.11%. Do you realize what is happening? Okay. When there is good news, which is this 110, the yield is moving in this direction. It is going down from 10% to 9.9. Do you realize the sovereign default spread is reducing? Do you agree? Sovereign default spread is reducing. It is a good news, right? The spread is reducing. If suppose there is bad information about India, what is happening to the price? 90. And what is happening to the yield? Yield is going in this direction. The sovereign spread is increasing, right? So how does this sovereign spread help? See, this bond, government bond, is continuously traded in the market. So whenever there is new information coming in, automatically the price will change. And the price will change because of the price is changing, your sovereign default spread is changing. And by looking at that sovereign default spread, you can say whether the country is becoming more risky or less risky. Is everybody with me till this point? All good? Not necessary that the spread should be minimal. See, this is a risk-free security because it's a US government ka same US bond, USD bond. So if you go more closer to that, okay, it is better. But we cannot say that the gap is always going to be zero. It is not possible, na? Because US as a country, the risk is different. India as a country, the risk is different. I'm going to repeat this entire part. We look at the price. Okay. So initially the price was 100. Okay. And what was the yield? 10%. If the price is increasing, the yield is reducing. So you're coming from this to 9.09%. Okay. Which effectively means your sovereign spread is reducing because there was a good news. The price went up, yield came down and the spread got reduced, which is a good news because your sovereign default spread is reducing. But if suppose the bad news is there for India, so what will happen? The price will go down and the yield will go to 11.11%. The spread will increase. That means the sovereign default spread is increasing, which is problematic because you're going far away from the risk-free rate or risk-free security. Right? I've answered the query. We are not checking the correlation. We are checking how your country's bond is performing. So lower the gap, it is better. That is correct. Now the interesting point. Why should we look at sovereign default spread? Why should not we look at the rating, sovereign rating? And a sovereign rating will take time to reflect. This is reflected on a daily basis because the bond is trading daily, na? And because the bond is trading daily, the price is changing. And because the price is changing, the yield is changing, and you can immediately see the sovereign default spread. All good? I'm taking a final confirmation before I go to the slide. For investor perspective, will he choose India bond or it doesn't matter. See, you are an Indian investor. You have businesses over here. You want to trust India. Now, why would you go to US? You're just looking how is India as a risk. You're not comparing India with US in terms of investment. Vikasji, right? You're not comparing whether I should invest in India or US. You're just looking at India. Okay, I'm going to go back to this section. Okay, what is the spread? Sovereign default spread. You're comparing two things. What is that? You're comparing the yield on your country bond, which is sovereign bond, okay, which is India government's USD bond, and you're comparing it with the risk-free bond. What is the risk-free bond? US government USD bond. Okay, US government USD bond. Now look at this example of clarity. Okay, look at this. Look at the example. So you have a 10-year US Treasury bond. What is the risk-free rate? 2%. Okay, same 10-year Indian government bond in USD. Yield is 8%. What is the gap? 6. This is my spread. This spread is based on the market. How come market? Because the bonds are traded in the market. And I just showed you when the bond price is going to change, the yield will change and the spread will change. So when you look at that spread, it is giving you the view of what is the risk of India. Now think about this. Prashant was planning to invest into Indian bonds. He looked at the sovereign default spread of India. It was 6%. Okay. After a few days, the spread increased from 6 to 6.5%. He will say that India is becoming more risky. I will not invest in India. That is what the logic is. Okay. I'm taking a pause. Any query, any confusion till this point? Any query, any confusion till this point? Now, how sovereign default spread helps? Look at the next slide and look at the table properly. This is coming from the institute book. Okay, can you see? So we have given you the rating. We have also given you the 10-year bond rate of that country and the US Treasury rate, and also this is the last column is the spread, the gap. Like for example, if you look at Brazil, 5% is the yield on Brazilian bond, which is a USD bond. And what is the similar USD bond? US government bond? The yield is 2.8. What is the gap? 2.15%. This is the sovereign default spread. Now, the interesting aspect is, okay, there might be two countries with the same rating. Okay, now they've given you the name also over here. I think so. They've mentioned Brazil and so, okay, let me just go over here 1 second. Can you look at Philippines and Colombia? Everybody, the rating is same. Now, when you look at only the rating, you will feel that Colombia and Philippines is exactly same as a country in terms of the risk. But when you, so rating, only by looking at the rating, you will not get the exact detail in terms of what is the difference. Okay. But when you look at the spread, 0.93, and what is the spread over here? 1.48. Which country is more risky? Which country is more risky between Colombia and Philippines? Philippines. So rating is not able to give you that bifurcation, but the spread is easily able to give you that. Because see, for example, even if Philippines had a spread of 0.95, still you can say, oh, 0.95 is higher than 0.93, so Philippines is riskier. Correct now? So over here, we have explained what is the sovereign default spread. Okay, they have taken an example of Brazil. So Brazil had a sovereign default spread of 2.15%. How did we got it? 5% minus 2.85%. Right? So this is an explanation, but the table gives you the clear picture that why sovereign default spread is better than rating. How it will help you. Okay. Now, the next important concept is the role of CDS. Now, what is CDS? I'll give you an example to connect. Okay, I'll quickly go to 1 or 2 slides more. Okay, look at this. Suppose you are a bond holder. You have purchased the bond of Coca-Cola. So Coca-Cola is bond seller. You are a bond holder. Okay, you invested in Coca-Cola's bond and the bond was for 10 years. Okay, the bond was for 10 years. Now what is happening? Okay, after a few years, you realize that Coca-Cola is becoming more risky and I don't know whether I'll be getting my money back. And you do not want to sell the bond. Huh? You want to hold the bond, but there is a risk that you're facing. So what you can do, you can purchase an instrument called CDS, credit default swap. So suppose there is a company called AIG, American Insurance Group, which is into this. So they are selling CDS and you're buying CDS. What is CDS? It's an insurance. Okay, and like any insurance, you have to pay a premium. So bondholder will keep on paying premium. And suppose that insurance is for next four years. Within 4 years, if Coca-Cola defaults, okay, Coca-Cola is not in a position to pay, and the bond was of say $10 million. If within that time frame Coca-Cola defaults, AIG will pay that entire amount to bondholder, like the insurance companies do. Is everybody okay on the example? Very simple. And you have to keep on paying the premium. Huh? Now, what is this? So whatever I've explained, it is written over here. CDS is nothing but it's an insurance policies for bond. So what is happening? I was the investor. Now, because I have purchased that insurance, I have transferred my risk to whom? AIG. Because if tomorrow Coca-Cola defaults, AIG will pay me the amount. So when you're buying a CDS, you're transferring the risk to CDS seller. And why would CDS seller take that risk? He's getting the premium. Right? Key features over here. Okay, if the sovereign bond defaults. Now, the example was Coca-Cola. Think about this as government bond. So you can take CDS on government bonds also. So if government bond defaults, the CDS buyer, the investor will be compensated by whom? It will be compensated by that AIG. Simple logic. Okay. What is the CDS spread? This is the premium. Now I'm asking a very basic question. Come back to this example. Now suppose, okay, Nitin has purchased the CDS on 1st of January. Okay. And at that point in time, the CDS premium was 3%. Okay. Now after 2 months, Lavesh, our student, he is thinking that I also want to buy this CDS. Okay. But from 1st of January to 1st of March, after 2 months, situation has changed. Coca-Cola has become more risky. The risk of Coca-Cola has gone up. So what should happen to that premium? Will it go up or will it go down? Obviously it will go up, right? So the CDS premium or CDS spread reflect what is the view of the market regarding Coca-Cola. Whether the market is anticipating that Coca-Cola is more risky or less risky. If the rating, this percentage goes down, that means the market is saying that no, this is less risky. Correct? Right? So a CDS spread reflects what is the view of the market on that particular bond. Right? Because think about this. If this Coca-Cola is becoming more riskier, okay, this 3% premium will increase, no? Because now AIG is facing problem. Right? So whenever you look at the CDS spread, you're getting the understanding that what is the market's understanding about that bond. Very important, huh? Look at this. What is the problem with CDS? It's such a good instrument, right? The problem is speculation. Now, see, whenever you take insurance, suppose you must have taken home insurance, you must have taken car insurance. You generally take insurance when you have some interest. I have interest in my life, so I have taken life insurance. I have interest in my car, I can take car insurance. But in CDS market, even if you have not purchased the bond of Coca-Cola, you still feel that Coca-Cola will default, you can go and purchase the insurance. This is called naked CDS. It is called naked or uncovered CDS. So a lot of speculators during 2007 and 8 also, they were speculating that Lehman will collapse and they purchased CDS on that particular entity. Similarly, you can purchase CDS on a particular country if you feel that the country is going to default. So a lot of speculation will happen. And when the speculation is going to happen, what will happen to the spread? Spread will jump. Why? Because more and more people are buying. So that 3% will go up, right? Correct? I hope everybody is good. Because sir, I'm answering to your query. They are not increasing in the contract. That's why I've given a very clear example. First, Nitin has purchased. He purchased at 3%. Now the next time Lavesh is going to purchase. Somebody new is going to purchase. The rate has gone up. So the first problem is speculation. Okay. Second is liquidity and counterparty. Now think logically. I have purchased the bond. I have purchased CDS from whom? AIG. Correct. But AIG tomorrow defaults, then suppose this is called wrong way risk. Okay, wrong way risk. What is that? Coca-Cola defaults, AIG also default. I'm gone. There is no protection available for me. So because this is an OTC transaction, OTC means I'm directly doing a transaction with AIG. If tomorrow AIG also defaults, the risk is high for me. So if tomorrow the CDS seller defaults, the buyer is going to face a problem. Secondly, this is not a contract which is happening on the exchange. It's an OTC market between you and me. Okay. So it is illiquid. Illiquid means you cannot immediately exit the contract. It's a formal agreement between me and AIG. Right. So if I want to cancel the original agreement, I'll have to do an exactly opposite agreement with the same party to nullify the original agreement. Right. That is why they are saying illiquid. You cannot exit the contract immediately. Correct? I've highlighted the point. What is the benefit of naked CDS? There's no benefit without, you're just speculating. No? If you feel this country is going to default, you just take a CDS, and if that defaults, you will get the money. See, I'm speculating tomorrow Sri Lanka will default. I have not taken any bond of Sri Lanka. And I'm going and buying a CDS on Sri Lanka. If suppose actually Sri Lanka defaults, I'll get that CDS amount, na? Because I've taken the insurance. Is everybody okay till this point? This example? Answering to your query. But if AIG default, what is the option? Then CDS, then there is no protection available. If AIG itself is defaulting, there is no protection available to you. Yes, obviously money gone. See, you have taken insurance from Kotak. Tomorrow Kotak defaults, then gone. Rahul, answering to your query, the spread will not be correct parameter if we are speculating. No, spread is different. I'm talking about, I think so you're talking about sovereign default spread. That is different. The CDS is different. If you're talking about CDS spread, it's a premium, na? It will go up and down in the market. It doesn't, see, it is not connected to whether you're speculating or not. Because this is not a normal insurance. It's a agreement between two parties. No regulator will come and say why you have done that. It is your problem. You take care of it. Sahi hai? Everybody's okay? Let us look at the questions. Chalo, look at the first one. First question, everybody. Which of the following statement about a country's default in the foreign currency obligation most accurately reflect historical pattern and institutional development? Read all the options. In recent year, instances of sovereign default have typically resulted in direct military action. No, this was happening back. So wrong. Countries with strong independent central bank, often it is easier to create money to cover the debt. No, then you cannot print. If you have an independent central bank, they will not allow to print. No? This is wrong. Prior to the 20th century, no sovereign state has ever defaulted. No, we have examples. So answer is D. Countries have historically shown higher tendency of default on borrowing from foreign banks. Okay, now in the slide it is not covered, but in the textbook it is covered. That most default that are happening is when one country is borrowing from a bank. Smaller countries, they borrow from banks also. And they are defaulting on that. Rather than borrowing from general public. Okay, so remember this point. Huh? I'm marking this as star. Remember this point. All good? Look at the answer. Which of the following statement least likely explains what a country might default on its local currency denominated obligation? Least likely, huh? We are looking at least likely. Please read the entire section properly. Countries may conclude that the negative effect of higher inflation are less significant than the consequences of default. That means they have to take a decision between default and inflation. They have to choose between them. So why they're defaulting? Is everybody listening? Okay, do you remember we talked about 3 points why historically countries have defaulted? They do not want to print more currency debasement. That was one part. Second was currency union, and then gold standard. So it is connected to all of this. Look at this. Before the collapse of Bretton Woods, the gold standard imposed restrictions. This was one of the reasons. But we are looking at least likely. This is one of the reasons. If you are a part of the share currency, like Eurozone, you do not have the ability to print, and because you are defaulting, that is correct, na? We are looking at least likely reason. This is correct. Some government may believe that economic damage from currency inflation is ultimately more severe, and that is why they are defaulting. This is also correct. So answer is A, which is the least likely part. Least likely. Okay. Right? If you read that first line also, they are saying the negative effect of inflation is less significant. And if it is less significant, then why are you not printing? Right now? Answer is A. Everybody. Answer is A. Look at the next question. Currency country ABC has recently defaulted on both local currency default and foreign currency default. In response, one of the leading economists published an in-depth article. In this article, economists carefully outlined a series of expected short-term and long-term consequences. Okay, which are the main points that the research must have taken into account? Okay, which of the economist observation is accurate as per the empirical data, historically what we have seen? So you'll have to read all the options properly. Default typically result in decline in the GDP. This is correct. Okay, generally goes down to certain percentage. However, the majority of the economic contraction occurs in the first year following the default. And so what they are highlighting is, now this is also written in the textbook, what they are highlighting is, whenever there is a default, immediately the research impact will be higher as compared to long-term impact. Okay, as compared to, so this is a correct point. We want to identify which of the points are correct. Next, sovereign default has a direct and lasting impact on a country's long-term credit rating. See, credit rating, overall country will not get impacted long-term, but the credit rating might get impacted, right? And the borrowing cost is going to be slightly higher. This is also a correct point if there is a default. Okay, now read this next point. Default by sovereign government can trigger retaliatory trade measures by affected credit nation, which tends to be disproportionately harm import land industry within the defaulting country. So they are saying trade restrictions will come. This has not been explained in the points now, because right now countries don't do trade restrictions. Historically there was military action trade restrictions. This is the wrong point. Look at the fourth one, last one. Higher chances of political upheaval means change in the government, leadership change. This was also one of the result of the partner. So answer is C. 1, 2 and 4th point is correct. 3rd point is wrong. I hope everybody is with me till this point. Can I get a quick confirmation? So with this, we have completed the chapter.